The Essays of Warren Buffett Part 5, The Truth of the Deal and the Web of Accounting. In Part 4 we saw that not every investment that appears safe is truly safe. A bank deposit can become weak from inflation, gold does not produce anything, and a high yield is many times the price of a hidden risk. Buffett directed us back toward productive assets, businesses, farms and properties that create something over time. But at the end of Part 4 the real question was left unanswered. If the business is productive, earnings are visible, and the deal looks attractive, should it be bought? Or does the shiniest deal sometimes become the most expensive trap for the investor? Imagine a CEO sitting in a boardroom. The presentation of another company is open in front of him, graphs are going up, the future looks big, and the advisor softly says, if we don't buy right now the opportunity will be gone. There is excitement in the room, but Buffett does not look at excitement first in this scene. He asks, is this deal truly giving value, or is it just the intoxication of increasing size? Right here the mystery of Part 5 begins. Mergers and acquisitions are not just a game of adding companies, but a test of discipline, patience and accounting truth. Buffett and Charlie Munger looked for a business the way someone looks for a life partner. It sounds strange to hear, but this very comparison opens up their entire strategy. Haste is dangerous when choosing a life partner. Everything may look perfect from the outside, but real compatibility lies hidden in time, values and trust. The same happens in a business acquisition. The company's sales may look good, the brand may look strong, but if the underlying economics are weak, the deal can become a regret. Buffett says that if you remain active, open-minded and interested, good businesses can be found. But if you become desperate, a wrong deal comes into your hands very quickly. And in the corporate world, a desperate buyer often becomes the seller's best friend. Because in a hurry, the buyer ignores the very thing that turns out to be the most expensive later. Buffett had made this mistake in his early days. He bought some businesses that looked cheap or decent, but the economic quality was not that strong. Gradually he understood that buying a mediocre business at a cheap price is not always a win. Many times, an average business eats up your time, capital and patience altogether. Then Buffett's strategy changed. He focused on businesses whose economics were durable, whose management was trustworthy, and which could be owned for a long time. Here comes a very important point. Buffett does not like small commitments, especially when it comes to an acquisition. If Berkshire enters a business, it does not enter with a trading mindset. It enters with a long-term ownership mindset. This is the exact difference between an ordinary acquisition and a Buffett-style acquisition. Buffett buys the business, not the headline. Now comes the matter of a merger. In a merger, a company often issues its own shares to buy another company. It sounds simple to hear, give your shares, take the other company. But Buffett follows a very strict rule here. He says that I will not issue shares unless I receive as much intrinsic business value as the value I am giving. Now understand this in simple words. If you are giving a $5 thing, why would you take 5 cents in return? This mistake happens repeatedly in the corporate world. CEOs use their stock like currency, but forget that they are selling the shareholders' ownership. If a company buys another company by issuing undervalued shares, existing shareholders can suffer a hidden loss. Because you are giving away your valuable ownership for cheap. The deal looks big from the outside, but from the inside the value gets diluted. Right here is where Buffett's discipline shines. For him, a merger is fine only when the exchange is fair, and the buyer understands the real worth of the asset. But finding out the real worth is not easy. Right here is where the story of intrinsic value begins. Intrinsic value is not an exact number that always comes out right with a calculator. It is an estimate of the present value of future cash flows. Meaning, how much cash the business can generate in the future, and what that cash is worth today. This very thinking is behind intrinsic value. But the future is not clearly visible. Therefore, intrinsic value is always an estimate, not a guarantee. Two sensible people can arrive at different intrinsic values even after looking at the same facts. The difference lies in the assumptions of growth, risk, capital needs, and the time horizon. This is why Buffett avoids giving an exact figure of intrinsic value in his reports. He gives facts so that the shareholder can think for themselves. This approach is unusual. Many companies want the investor to accept their version, but Buffett gives the responsibility of thinking to the investor. He says, look at the book value, but do not consider it the final truth. Book value is just a snapshot of accounting. Book value is connected to assets minus liabilities and gives an idea of shareholder equity on a per-share basis. But the real value of a business can many times be very different from the book value. A strong brand, pricing power, or customer loyalty does not fully show up on the balance sheet. On the other hand, a company's assets may look big, but if they give a low return, the book value can give the investor more comfort than it should. Right here is where the web of accounting begins. Numbers can speak the truth, but they can also show a half-truth. Therefore, Buffett pays attention to earnings, but not just to reported earnings. He wants to see what the long-term earning power of the business is. 1 year's earnings can sometimes be boosted by special circumstances. An asset sale, an accounting gain, or a temporary boom can make the profit look beautiful. But Buffett asks, can this earning be repeated? Can the business make cash for the next several years? This is the difference between reported profit and owner earnings. Owner earnings is the money that truly remains for the owner after the necessary expenses to keep the business running. If the company shows a profit but demands a lot of maintenance capital, then the owner's real earning can be low. Therefore, Buffett does not just read the annual report, he understands the economics behind it. Now comes the matter of leveraged buyouts. In a leveraged buyout, the buyer uses a large portion of borrowed money, meaning debt, for the acquisition. On paper, this strategy can look attractive. By putting in less equity, a big business is controlled, and if everything goes well, the return increases. But leverage is also a double-edged sword. If the business becomes even slightly weak, the cash flow gets suppressed, or the interest burden increases, the deal can become dangerous. Debt amplifies returns in good times. In bad times, the same debt makes survival a question. Buffett maintains caution in such deals, because his focus is not on maximum excitement, but on permanent capital preservation. Now that story of the sick horse comes to mind. A man tells a doctor that his horse sometimes limps and sometimes walks fine. The doctor replies, sell him at the exact time when the horse is walking fine. This joke opens up the reality of corporate acquisitions. Many sellers sell the business when everything is looking good. But the seller knows the internal weak points better. The buyer sees the presentation. The seller sees the reality. Therefore, Buffett looks at the durability of the business more than the excitement of the seller. He asks, will this business remain the same even after it comes to us? In many acquisitions, the biggest asset is not numbers but people. Buffett likes companies where owners have built the business with love and want to manage it going forward as well. This is very important. If the founder just wants to take the cash and exit, the buyer should think, will the soul of the business survive after he leaves or not? Buffett likes owner-managers because they have emotional ownership. They do not consider the business just a job. Such people understand customer relationships, culture, and reputation even more than numbers. And many times, those very invisible assets make the deal valuable. But not every founder-led business is automatically great. Passion is necessary, but economics and discipline are necessary too. Buffett understands this balance. He wants honest managers, but he also wants a business model that produces cash in the long term. Now comes another hidden trap: acquisition fever. When companies do one deal, then a second, then a third, the size increases, but the quality does not increase every time. Wall Street often celebrates growth by acquisition. The revenue became bigger, the employee count rose, the market presence expanded, and a headline was made. But Buffett asks, did the per-share value increase or not? Did the owner's stake truly become stronger, or did only the empire grow bigger? This question is very powerful, because a CEO's incentive sometimes gets tied to size, not to shareholder value. Running a big company increases prestige. Media attention is received. Compensation also many times increases with scale. But the shareholder wants a return, not prestige. If the acquisition is destroying value, then becoming big is not an achievement, it is a warning. Accounting can play a dangerous role here again. After a merger, numbers get combined, and a bad deal can be temporarily hidden. Goodwill can show up on the balance sheet. A story of future synergy can be told. But the real test will be in the cash flow and the return on capital. The word synergy sounds very beautiful, but Buffett does not accept it without proof. In many deals, it is said that two companies together will reduce costs, increase revenue, and dominate the market. But in reality, cultures clash, systems are different, managers leave, and the expected benefits arrive late. Therefore, Buffett likes simple deals: a business that can be understood, a manager who can be trusted, and a price that fits into common sense. Now comes the turn of the Black-Scholes model, which is used to find the theoretical value of options. It is widely taught in business schools, and it is needed in many places in financial reporting. Buffett and Charlie understood it, but they did not maintain blind faith. Over a long period, the model can give strange results because assumptions can move away from reality. Meaning, the model can be useful, but a model is not a replacement for judgment. Formulas give comfort in finance. But Buffett repeatedly points out that business sense is more important than a formula. If the formula says the deal is fair, but the economics of the business are weak, the investor should still remain cautious. Right here, the central lesson of Part 5 comes forward. The biggest risk in an acquisition is not the price, but a wrong understanding. If you did not understand the business correctly, did not understand the seller's motivation, did not catch the web of accounting, and overestimated the intrinsic value, the deal will turn out expensive. This is why Buffett remains patient. Missing an opportunity is acceptable to him, but getting stuck in a bad deal is not. Because a bad acquisition does not eat up money just once. It can eat up management attention, future capital, and reputation as well. Buying a strong business can speed up compounding. Buying a weak business can push compounding back by years. In Part 4 we asked, what does the asset produce? In Part 5, the question has become deeper. What is the real value of the business being bought? And is the buyer truly buying value, or are they just buying the seller's good timing and the advisor's beautiful presentation? Buffett's philosophy of mergers and acquisitions says just this: do a deal only when the business is understood, the price is fair, the management is trustworthy, and the reason for long-term ownership is clear. If even one of these pillars is weak, an impressive deal can turn out dangerous. The payoff of Part 5 is just this: Buffett does not consider deal-making a game of speed. It is a game of patience, honesty, and valuation discipline. But the story is not over yet, because the next question is even more personal. Once the business is bought, how should owner earnings, accounting choices, and shareholder communication be understood? In Part 6, we will go to that place where the company's report speaks to the investor. But does it tell the whole truth, or do some numbers change the story behind the curtain? Because in Buffett's world, the real question is not just what was bought. The real question is, what did the owner actually get after buying?
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.